Welcome to this episode of Retirement Crusaders. Today we're going to talk about why Neil does not buy fixed income instruments such as bonds in retirement and why he thinks they're a bad bet. And I'll tell you why I think they're a good bet, and so we're going to let you make your own opinions from what you hear us talk about today. So Neil, let's get right to it. You don't buy bonds. You're retired. Why not? Bonds are what, typically bonds are not for younger people, and they're the domain of older people because they pay fixed interest rates.
Right. I don't like bonds, never liked bonds for a couple of reasons. Number one, there's no hedge against inflation. You get the same rate, that's it, doesn't go up, doesn't change. Number two, the taxes, well, in retirement accounts, it's irrelevant, but if you're having it in a non-retirement account, the taxes are terrible. You have no capital gains treatment. But much more important, equity has over the long run, has a much better return. So for example, if you look at the return of stocks over the last 100 years, 10%, if I take out 4% as income and then bump it up for inflation every year, I'm going to have a lot more income and a lot more capital. That's the reason, just because I like to have more retirement income.
Okay, well, that makes certain sense. Now, we don't have to get into the details now, but I can comfortably buy preferred shares and bonds all day long at, say, 9%. And so you're right, equities have yielded something around 10 to 11%. So you do get a little bit more with a heck of a lot more volatility.
Well, excuse me, you do get a lot more volatility. So let me just address this 9% issue. So I'm not an expert in bonds. Most of the people watching this video are not experts in bonds. I know that you did a fantastic video on how to find the right bonds, but most people are not going to do it. Most people are afraid of high yield bonds, or junk preferred. They're not going to do it. They're just not going to do that. So I don't think that's a viable alternative to compare bonds. And even more important than that, even if I did know what I was doing, okay, you have the risk when you buy a bond that's paying 9%, which is, like I said, a junk bond, that you could lose 100% of your money. Forget about market volatility. We're talking about the ongoing concern. If the company goes kaput, you lose 100% of your money. With stocks, you can have stop losses, you can have allocation, you can use funds where you don't have that kind of risk. So in my opinion, Larry, with all due respect, you're taking a lot more risk with those bonds.
Well, certainly if somebody doesn't know how to pick them, I would agree with you. So yeah, you've got to pick bonds where there's very significant interest coverage, where the company could lose 30, 40, 50% of their business and still make their bond payments. You've got to obviously know how to pick companies like that. Agreed. But it's not like you lose all your money. When companies start doing badly, it's not like they go from doing fine one day and they're broke overnight. The pattern, you can start to see the pattern of, risk. And I have had bonds in my lifetime that I've sold when the situation looked to me like it was starting to decay, and it's easy to get out, before it actually gets really bad. So I'm not sure that it's a binary situation where it's like you have $1 and then suddenly you have zero.
Okay, fair enough. But again,
anyway,
that's fair enough. But you do need expertise there. You do need expertise. And by the way, and we're going to probably get into this in a minute. People talk about dramatic stock market falls, like depressions, recessions. Those significant events, market events, they also impact the ability of those companies to make their bond payments. So if there was, for example, if you look at the Depression, which was the very worst event, or the Great Recession, there were plenty of stocks that lost a lot of money, and at the same time, that impacted those bond values.
There's no doubt about it, but bond values to a smart bond investor are irrelevant. And what I mean by that is, and I've said this before in many other videos, you don't buy bonds to trade them, you buy them to hold to maturity. So if the bond falls by 20 or 30% because people are worried about the economy, as long as that company stays in business and you hold it to maturity, you get your face value. So I'm not ever worried about the fluctuation in the price of a bond because I'm not going to sell into a bad market. So that's irrelevant.
Okay, well, it's not irrelevant in that you just said that when you start seeing things deteriorate, you sell. So it depends on who, what your triggers are. So you, as an expert, may look at, oh, that's a market problem, that's not a company problem. Other people, again, watching this, they may not have that expertise.
Correct. You obviously have to tell the difference between whether it's a problem in the economy, and that's why your bond values are down, which is irrelevant, or it's a problem with an individual issuer. No doubt about it, one has to make that distinction. Right. But in bad economies, companies cut their dividends far quicker than they cut their bond interest, because cutting their dividend is discretionary. There's no guarantee. If a company pays a 4% dividend last year, they could declare no dividend the next year. Whereas bonds, if they have a bond is a contract, if they don't pay that interest, the creditors can then start bankruptcy proceedings. So companies almost never miss a bond payment unless they're going to go into bankruptcy. So stock dividend cuts and bond interest cuts are night and day.
But I don't care. I don't care. In fact, over the last 10 years, my worst performing stocks, and my stocks have performed pretty well, thank goodness. The worst performing stocks are those that pay dividends. The best performing stocks in my portfolio don't pay dividends or pay very small. So it's not a dividend play for equity in my view.
I just want to point out that if you like this type of video, you should definitely click the subscribe button and the little bell icon so you get notified each time we do a video like this. And then also below in the description, you can get one of my and Neil's 10 booklets on different retirement topics, and also join our Facebook group to join in discussions like this with other people who are in your same situation in life. Right. Well, my biggest concern is that people who have 100% of their money in the stock market, I think the risk is relatively significant. And what I want to show for a minute is to just take a look at, so I'm looking at a chart here. This is the S&P 500. And what I'm looking at here is if I take this peak here in 1968, I have to go, 19 years before the market got to that same place again. So, for the average person to wait 19 years for the market to recover during, say, a 30-year retirement, I mean, that's pretty significant, particularly if they're taking out, 4 or 5% a year, whatever, to live on. That portfolio is going to really erode in value during a prolonged bear market like that.
There's no.
What do you do?
Okay, so there's a couple of things. First of all, I would say that nobody in retirement has 100% of their money in equity, and I'll tell you why. Number one, if you get Social Security, that's like owning a bond. You get your $2,000, $3,000, $1,000, whatever. That's like owning a bond, even better than a bond because there's a bump for inflation. Number two, if you own your own home, right? That's like owning, or rentals that are creating income, or that if you own your own home and you don't have to pay rent, that's like owning a bond. So that's diversification, again, or away from equity. So that's number one. In my particular case, just looking at those two things, 30% of my money is outside of equity. All right, so that's number one. Number two, there's no question that there's that risk, and that period that you just showed, that's a risk. There's a couple of ways around that. Number one, you have to ask yourself, what are the alternatives? It's not that it's either investing in equity or getting a 10% tax-free government-insured bond. Okay, there's other risks outside of that. So I don't know what happened to bond values during that time, and I don't know what happened to companies in terms of their ability to continue making payments or even stay in business during that time. So that's number one. So there's other risks outside of that. Number two, there's the ongoing risk, not just during that 20-year period, but through our entire lives, through the economic history of the world, of inflation. That's a real problem that everyone faces every single day. It's not an outlier event, it's a real thing. Right, and then you have to look at, I'll show you, you showed me a very nice graph, I'll show you a couple of nice graphs. Here's a graph that shows stocks versus bonds. let's see, let me pull up that's since 1940. And you can see that the purple, or excuse me, the turquoise line shows those periods where stocks outperformed, and the golden line shows where the bonds did better. And there's some very small periods of time, very, very small periods of time, where bonds outperformed stocks, or stocks did worse than bonds. But for the most part, stocks did far better. So yes, there's that risk, but do you want to be the house, or do you want to be the gambler? You want to gamble on bonds and figure this might be the time? Or do you want to be the house where the odds are in your favor? The next...
Well, I'm not... go ahead.
Right. The next... Well, no, go ahead, and then we'll come back to the income theory.
I'm not arguing that bonds would beat stocks. I would never argue that, because that's not true. Stocks will beat bonds over long term.
Okay.
Now, the key is that one of the things that's a little, I don't want to use the word deceptive, but misleading, okay, when people look at those types of charts you have, is that what they're measuring about bond returns does not coincide with a smart investor's experience. Now, here's what I mean by that. If you take a year's snapshot, in a year when, say, bonds went down 10%, their market value fell 10%, that's what you see in those charts. Okay, you see the total return of bonds year by year. But that's irrelevant to a smart bond investor, because a smart bond investor buys a bond for $50,000, holds it to maturity, and gets $50,000 back. And those returns year to year, the fluctuation is irrelevant. And that's always what is shown on those charts, which is the total return, which is if you owned a bond fund, that's what you would experience. But when you own individual bonds, you don't experience that, because at maturity, you're going to get your money back. So I just want to point out that those charts that they show a chart of stocks versus bonds, it's not apples and apples. It's a bad comparison.
Okay, fair enough. Fair enough. I don't have. Well, actually, I do. Let me show you something else that you might more easily accept. Here's a chart that. Okay. I don't have what the average bond holdings returned during these decades. I don't. But you can see during the 2010s, the average return was 13%. In the 2000s, it was a bad decade, minus 1%. In the 1990s, 18. In the 1980s, 17. In the 1970s, about 6%. Before that, 8%. So the returns we've already established over many years have been much higher with equity. That's number one. Number two, when you buy bonds, you're getting, let's say, quote unquote, more security. Now, I don't buy that with the 9% bonds, because you're a very smart fella, one of the smartest guys I know, but not everyone has the expertise that you have, and I don't believe that people are going to be able to replicate your experience. But when people buy bonds, Larry, what they're doing is they're buying insurance. They're getting security. They're getting sleep at night, right?
Yes.
Okay, good.
Yeah.
But you're not paying $30,000, $40,000 a year for that insurance. You might rethink your decision to buy that or not, because it would be too expensive relative to the risk and relative to the gain. And the problem is when people buy bonds, or they buy too much bonds because they want more sleep at night, right? Well, they're basically paying a lot of insurance. Maybe they're giving up 20 or 30% of their potential income over their lifetimes as a result of that. And it's too damn expensive.
Well, I agree with everything you're saying, because it's true over the long run. But I think it was the economist John Maynard Keynes who said over the long run, we're all dead. So the problem is that people's experience is not like when you look at one of these charts of 90 years of stock market history, they're not in it for 90 years. They're in it for, say, a retirement of 30 years. And so let me just address what I'm saying. So in this chart here, sequence of returns, it shows, so we have two situations. Situation A here, investor A and investor B. And investor A, they both start with $1 million, and they're taking out $50,000 a year. So investor A has the unfortunate experience that the first 3 years he's retired, the first year the portfolio loses 17%, then 11, then 4%. And what happens is, because he has to still withdraw that $50,000 a year, by year 15, his portfolio is at zero. He just had these really bad years in the beginning. Now, interestingly, hypothetical investor B, you'll notice that the returns are just flipped, meaning he had the bad 17 minus 11 late in the early years. He had positive returns, so his portfolio that started at $1 million grew to $2 million, only because in the very he did well in the very beginning. But if somebody has the bad experience to have a few bad years at the beginning of their retirement when they're taking withdrawals, they can very quickly exhaust their portfolio. And so
Okay.
no argument with me that stocks do well over the long run. The problem is, over 30 years that a person experiences retirement, he could go broke if he had bad experience and he had a very large portion of his money in stocks.
Okay.
That's my concern.
I gotcha. In an from an academic standpoint, you're right, but here's where you're missing the point. In my 30 years experience working with clients, right? You think that people don't reduce their spending as a result of market performance? You'd be wrong. Okay, in my particular case, what I do is I take out 4% of my values. If the markets are higher, I'll take out 4% or less. If the market drops, I'll take out 4%, and that means my income may drop. Now, you might think that no one can do that, but you're wrong. My experience over my entire career was that people would come to me and say, should I take out less money? Okay? Now, you might think that people, there are some people that maybe can't do it, but most people can. Look at what's happened. I'll give you a crazy example. Look at COVID. We went from one day being an open society where you can come and go and do what you please, almost to the next day, you got to stay home, you can't leave your house, you got to wear masks. Everything changed very quickly. The human being is very adaptable to new situations. And I've seen in my own my own practice where clients had some adverse situations and they were very quickly able, and they were forced to make changes, and they did, and it didn't kill them, and they were fine, and they were still happy people. So to make, hold on.
I don't just, yeah, okay. Go ahead.
So there are some very interesting studies. Then we'll probably do a follow-up to this called the guardrail income strategy. I don't know if you're familiar with that, but there's no problem in taking some small cuts. So if, for example, if I take out 4% a year instead of 4% plus inflation, which I believe that's what you showed in your sequence of events slide, then I can't run out of money because I'll just take out 4% over of a lower portfolio. Now, in the situation of 68 to 82, where it didn't do anything, that's, I'll eat into 40%, 50% of my value. So what I'll do, all right, is maybe I'll do more consulting work. Maybe I'll do more writing. Maybe I'll change my living situation where I'll downsize. Lots of different opportunities, and it's not going to kill me or my wife. It's no problem.
Right. However, so I just want to put what you said in perspective, because what you said is clearly understandable. But what we need to put in perspective is the following. If the 4% income is just, let's say, $150,000 a year, let's just pick a hypothetical number, and your non-discretionary expenses, your living, your food, your utilities, are half of that, then sure, what the heck? You'll just take less. Right. But listen, don't be an elitist. There's plenty of people watching this video that say, hey, my income exactly meets my non-discretionary expenses. In other words, if my income falls, I don't know how I'll pay my rent. I don't know how I'll pay my food and my utilities. And there are a lot of people during these downturns and periods, they had to move in with somebody else, or they had to sell their house. And so they did have hardships.
Yeah,
so
but
I just want to point out
those
that
people were, those people were probably not investors, Larry. Okay, there probably weren't investors with that used to have $150,000 or $100,000 worth of income or they were pulling $100,000 from their portfolio, probably. Okay, but let me get to your point. I agree with what you're saying. It's valid. That's why the name of this video is why Neil doesn't buy bonds. Okay, and that's why we always tell people it's important for everyone to talk to their own advisor. The worst advice anyone could ever give or take would be to watch a video on YouTube and then implement those ideas for their own particular situation. The smart way to do it is to listen and get ideas. For example, I've said before, you own a house, free and clear, that's like owning, that's a diversification tool. You get Social Security, that's like getting a bond. So that might switch someone's thinking. Maybe someone watching this doesn't put 100% of the money into equity, but maybe they might see it as, I can reduce my income. And by the way, over the long run, the stocks have done much better. The odds are in my favor. Instead of 50%, I'll go to 65. So I'll consider that a win. I'm not trying to get everybody to put all their money into equity. I'm telling you why I do it, and I'm in a situation where, thank goodness, I can.
You know, there's another issue that we shouldn't fail to mention, and that's people's emotional stability. And so, look, you and I were in this business for decades, and so to us, the market goes down, we ignore it. You know, we know it comes back, and if it takes 3 years or 8 years, who cares? I mean, that's the viewpoint you and I have, because we have enough. And if it takes longer, it's fine. And you know, like you said, we have the ability to go out and make income and consult and do all this stuff. You know, that's not a true situation for many people. And so the emotional issue is a big one here, which is that you and I don't freak out if the market goes down 20, 25, 30, 40%. We're like, okay, whatever. You know, I mean, to us, it's just like another day at the office. The average person, they're like freaking out. They're thinking, I'm losing all my money. They'll go crazy. And so I would argue that at most somebody in retirement maybe should have 50% of their money in equities, solely for the emotional stability that if you have half of it in this place fixed income instruments, whether they be preferred shares, whether they be bonds, whether they be mortgage notes, trust deeds, anything like that, where you know, look, no matter what happens, I know unless there is a calamity, you know, another depression, I know that I'm going to get 8%, 9%, 10%, whatever from this chunk of my portfolio. So it makes one feel a lot better than if this side's their equities are down 20 or 30%, they can still stay the course, because the average person freaks out. They don't have the emotional stability, or I'll call it even emotional maturity, to weather 30 and 40% downturns, which are not that uncommon.
Okay, so there's a quick chart I want to, that's a critical point, but I want to put that in perspective. I want to show you a chart that shows the different downturns and how long they've lasted. I'm going to come back. Okay, so look at this break even after bear market. And it shows, yeah, in 1929, it took 13 years for the market to come back. And there were other periods where it took a year, a little over a year, or 3 years, or 6 years. But for most of these bear markets, it was a question of months. Most of them, not all of them. Some of them took a longer term. Okay, so let's have some perspective there, number one. Number two, you're right. Even if it's for 2 weeks, if the market drops for 30%, some people are going to freak out. That doesn't mean, okay, so if that same person has the ability to buy mortgages and trust deeds and preferred shares at 8-9%, I think you have a valid point. I wouldn't say 50%, but I think most people are going to put their money into bond funds and get 4 or 5%. And basically that's costing them, depending on the account values, maybe $20,000, $30,000, $40,000 a year. And that insurance is too high. I'd much rather pay an advisor, a good advisor, $2,000 a year, $3,000 a year, and not give up that $20,000, $30,000 that I'm giving up in quote unquote sleep at night insurance. So it depends on the person. I think you have a valid point for some people.
Yeah, and agreed. And I'm concerned for the average person of, and whether we can call it a black swan event or not, but that period from say 1968 to 1987, a 19-year period until the S&P actually, equaled the same level. People did get dividends during those 19 years, but the value, the index didn't reach the same point for 19 years. And the average person, I don't know if they have the emotional stability or financial stability to be able to weather that and not take their $50,000 a year or 4% or 5% and keep eroding that portfolio. And if they have the feasibility and possibility to go out and earn income and do other things, that's my concern, is that it's possible, not likely, but possible, we can have one of these long periods of downturns, and then I don't know how most people would weather it if they didn't have a substantial portion of money providing a fixed return every month, every year.
Well,
that's my concern.
Well, like I said, it's valid. The first thing I would say would be this: if you're a renter in retirement, maybe Larry's just made the case to go out and buy a small place or buy a place to live in, because that, in effect, you take the money out of the stock market and buy a residence. You don't have to worry about inflation on the rent, and it's sort of like owning a bond or owning a rental. I think it's a valid point.
All right. Is there any issue you think we haven't discussed that's really pertinent to this issue of, this allocation issue between, fixed income and equities? Do you think we missed anything? We've talked about the returns. We've talked about these downturns and, what people could do or what they can't do. We've talked about the emotional issue. Have we missed anything that is an important thing for viewers to consider?
Well, we've already talked in earlier videos about staying away from bond funds, so that's important. Number two,
absolutely, stay out of bond funds, right?
And although you're right, Larry, that long periods of downturns are possible, we haven't had very many of them. In fact, so you want to make sure that you don't overpay for that insurance against that, and you want to have a plan. I think that the most important thing is you want to have a plan, like, am I going to cut back if there's a downturn? A more likely thing for 3 or 4 years, if there's a downturn, am I going to cut back? Am I going to reduce my expenses? Am I going to be able to earn more money? You want to be thinking about what you're going to do, because those things do happen. Have we missed anything else? Oh, and I just want to drive home the point that even though I'm, and me and Larry are not currently advisors, this is the reason why you want to talk to your own advisor before you make, investment decisions. I think that's really important. Excellent.
Okay. Well, great. So I just want to point out that if you like this type of video, you should definitely click the subscribe button and the little bell icon so you get notified each time we do a video like this. And then also below in the description, you can get one of my and Neil's 10 booklets on different retirement topics, and also join our Facebook group to join in discussions like this with other people who are in your same situation in life. Neil, anything to add about that?
See you soon. Subscribe and interact with the Facebook group, and we answer all the questions that you have. So if you have anything that you need a question answered, let us know.
See you next time on Retirement Crusaders.